All right. Well, thank you, Drew. I appreciate you having me. And before I get started, just kind of the normal thing. Nothing contained in this presentation is financial advice. So it's just how I approach the market in the context of everyday trading. All right. So how to spot a rip your face off rally before it happens. We'd all love to catch these type of moves, right? 76 points in one day on January 8th, huge ripper, right? And then on the 18th, the 19th of January, 100 points. Crazy moves. These are just amazing. Then into FOMC last month in December, 127 points over 4 days into FOMC. Okay, so we'd all love to catch these moves, enter at the bottom, ride it all the way up to the top. The reality is, as a day trader, you won't. You'll probably take quick profits and watch it rip up without you. And really the reason behind that is you lack an understanding of what's happening under the hood of the market. So as a day trader myself, who trend trades, I try to think about this a little bit differently. All right. I'm not trying to catch tops and I'm not trying to catch bottoms. It's really about risk. Should I be taking profits at my normal 5 to 10 ES points, or is it an environment where I can press and make more money in trades, make more trades, and have a strong conviction in the direction it's going? Although they don't happen too often, there are a lot of filters that can help you determine before a huge move happens. So you can determine whether or not a very large move is on the precipice of happening. So for those that like poker, it's more, you can equate it to the difference between holding a pair. Maybe you can knock off a few points, but if you're holding a full house, you want to knock off the entire pot, right? So that's how we're thinking about this. So you don't need a better signal. You need a better filter. And this was a really great quote from Jason Strimple from PyQuant News. He's a quant trader, pretty famous in the Twitter sphere. He's worked with some of the biggest institutions. And this little quote here really got me thinking when I started developing my own trading system. So I was constantly thinking about when was the best time to buy, when the best time to sell was. It's not always about when, but a number of factors and filters need to come into play first and make sure that there's an environment where you can press and you can keep pushing your trades, right? So basically, you want to be able to know the trading environment conditions. You want to make it easy. You want to make it so easy where it's hard to be wrong, right? So, which is going to lead us into the agenda for today. Let's go ahead and do that. This is what you'll get out of this session. A lot of this will be about market context and when a price move will happen. You want to see the price action that's leading up to that event. You want to look at advanced volume, the SPX market maker gamma exposure, and then we'll put it all together and we'll do some Q&A. So we'll go through these 4 components and put it all together. Sound good? All right. So a little bit more about me. I was in finance and accounting to start my career at Bloomberg. For 7 years, I was capturing, normalizing, and tracking equity fundamental data for various industries, such as tech, media, and telecom. So think fundamental data in the areas of the income statements, balance sheet, cash flow, transcripts, consensus estimates, supply chains, insider transactions, and ultimately valuation metrics for public companies. So during that time, I got a really great understanding of what drives big institutional investors. But what it really did was open my eyes to data analytics and now data science. So even though I didn't have a computer science background at the time, I did know data. So I took a ton of courses from Johns Hopkins and learned data science and machine learning. Subsequently, I joined an advanced analytics company, Revolution Analytics, We ended up getting bought out by Microsoft, and at that time, the Revolution Analytics was data science using like R programming at the time. So at that time, it was R and Python kind of going head to head, and the commercialized version of R was Revolution Analytics. So at that time, we got bought out by Microsoft, and that's where I spent another 7 years writing the machine learning and AI wave using Python. So there we're implementing a lot of enterprise systems for all kinds of industries. And I was a program manager and product managers for several different areas in Microsoft. So towards the tail end, I got pretty tired of the meetings. 5 layers of management always that just keeps getting shuffled around. So I decided to take what I learned over the last 10, 12 years and apply it to the markets. I really like the idea of day trading, even though most of my 15 years prior experience trading was swing trading and longer time frames like portfolio management. I love the idea of not dealing with overnight risk. So hitting some trades, putting some money in my pocket and just being done with my workday, then having the free time to do what I wanted. So 2020 and 2021 was actually really good at day trading. It was awesome. I think a lot of you guys can probably agree. I think a monkey could have made money in that time frame. It was just went straight up. It was awesome. So 2022 then entered the chat, and this is when I got a huge wake up call. I didn't have at the time the firmest grasp on intraday mechanics. The volatility and whippiness was very difficult. I took a lot of L's trying to figure it out. So after a lot of time and money and stress, I applied some learnings from my past, data analytics and back testing, using some frameworks I've used from Microsoft. And I used a metric ton of back testing and forward testing, all kinds of different techniques. And what it really boiled down to was finding the factors that matter are more about the environment you're in, from a risk, volume, and time perspective. And it was born. So I got a really good idea of what was driving things, and I wanted to share it with people like me. I'm retail, just like you, and I really wanted to see how people respond to it and could see what really happening under the hood instead of just seeing price action bars, right? So that's what we're going to do today. So let's get started, and I'll go ahead and share some super important filters that really help my trading out. All right, the first thing is the calendar of high impact events. I really hate to break it to most social media guys who just trade price, but you need to know what the hell's going on, or you're going to get killed, absolutely wrecked. And you need market awareness and context. And by awareness, I mean you need to know what impactful economic releases are happening today, tomorrow, and over the next week or two. And by context, you need to know what the narratives that are driving the market right now. Or in other words, are expectations in line with these data releases and the Fed, okay? Financial juice actually makes it really easy to see what's coming and what the market is expecting, and also the context behind it, right? It's really slick. I love it. It's similar to the Bloomberg terminal. You've got your streaming news, your red headlines. It's telling you the context all in one view, and it's modern, right? You can do all the filtering and everything you need. It's not Bloomberg driven where you're putting in all kinds of commands in order to do it. You just point and click, and there it goes. And it also automatically shows you the context behind the headlines and then the price action behind those headlines. It's awesome. I mean, it's really great. I've actually replaced Twitter with this. It's really, really good. And the fact that you guys are here, you already know this, so it might be a little redundant. So when we think about the most important and high impact items, we're thinking about FOMC, obviously, CPI, NFP, Fed speakers. These are really high impact events that price is going to move, more than its average true range on any given day on these days, right? And what we're trying to really kind of understand is like how these macro events are tying into Fed rate decisions. So look, we really have a pretty good idea of the story. Okay. When COVID hit, the Fed cut rates like crazy. The government flooded the system with cheap money and inflation hit. Prices on all assets soared. Then rates needed to be hiked like crazy to contain it. The market sold out. And then the markets were expecting a pause. We got the pause. All right. The markets soared and now they expect a cut again. Okay. They want to see a market, they want to see interest rates cut at some point this year. And what's great about Financial Juice, you can see what markets are betting on when that might happen. And if it's in line, all right, great. If it's not, maybe we see some bumps in the road. So from an institutional level, we're looking about like, is it risk on? Is it risk off? And if there's no serious head fakes, and there aren't any like tail risk events that are happening. So that's what institutions are looking at. But what the market does at the moment of any of these events when they are announced is anyone's guess. Okay, it's the moments leading up and what happens after the smoke clears that I, as a trader, am really concerned about. My take is that these events are an opportunity for large funds to execute their big block trades in a high volume environment. And that's why sometimes the initial price reaction doesn't always jive with the economic release performance. So Financial Juice has a pretty nice little beta tool here where you can see the events lining up with the price action when they happen, right? It's really cool that you can go back and see that. But let's take a look at what happens when you don't know what's going on. Back in December, Jay Powell, he had a fireside chat at a university, December 1st in 2023. I remember seeing on like the Twitter news flow and some other news sites, this wasn't scheduled in, or at least it wasn't popularly shared. So, this market was kind of drifting downwards, sideways. And then once he started talking, it just ran up 40 plus points. And it seemingly went out of nowhere. A lot of people were kind of caught off guard, but it was really just Jay Powell talking dovishly. And whenever this man opens his mouth, the markets will run. So if you're not understanding or you have a good view of what is happening right now in the context of what's happening right now in the news flow, you're going to get burned, especially if you're trying to go short and you keep hammering at this and you don't understand why. All right. So, and then we have the moments leading up to CPI. During this week, there were just not a whole lot going on. Not a lot of high impact events. Sure, we had some bond offerings and things like that, but really it was just drifting downwards. And when you see this, you kind of wonder what's going on. And right now, there just wasn't a whole lot that was pushing the market, and it just started drifting down for no real apparent reason. And then the week of CPI, which is a major impact event, you get your face off rally, right? You get almost 80 points in one day. And you see people either short covering, you see people trying to front run, which causes these prices to absolutely go bananas. So the idea is never trade without knowing what's on the calendar. Otherwise, you're going to get burned. Now this is going to lead us into what happens with the price action. The way I look at it, we're going to look at really what's leading up to the event, what's happening before. And what we're trying to look for is consolidation. And kind of like the days leading up to CPI, you're looking at retracements on high time frames, and it's unusually programmatic. So what does that kind of look like? Consolidations look like this in the boxes that I'm showing here. And really all this means is that price is not expanding. They're not making new highs or lows in a particular time frame. This is otherwise known as chop, the doldrums, or maybe volatility compression. I prefer the retracements from higher time frames, but it's going to be in a systematic or programmatic way. So let's take a look at what this could look like. So if I'm really interested in a retracement, it's going to kind of have this pattern here on the far right. And if you're wondering what these dots are, this is a indicator that was made famous by John Carter. I'm sure most of you guys have heard about it. It's like the squeeze, but all it really is doing is measuring volatility compression or consolidation. Nothing more. There's nothing to this thing. There's no context with it. It's just giving you a statistical alert that, hey, there's some consolidation happening. And that's all I take it for, but I like to kind of see it before events. So here's a perfect example. We've got a 30-minute chart on the top. We've got the 4-hour on the bottom. And you can see just how programmatic this is. We've got the lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And it's drifting down all the way through that Friday. Nothing to it, not a whole lot of news. It just wasn't doing much, just drifting down. And we start seeing the volatility compression start stepping in. So once that happens and we go into the next week, all right, this is a 30-minute, and then we're going to drop down to the 10-minute. You can tell that this price consolidation usually precedes humongous rallies. And just by putting a line there, you can obviously see it go, right? It goes another 50 points in one day. Not too bad if you know that's coming. But look, you just have a line there. You don't know that it's actually going to happen. I mean, this is like, hey, what are you really leaning on here, right? You can't do that every single time, especially it's on a Monday. Well, why? Why would you do that? So when you have people that are identifying price patterns and they're like, hey, this is a bull flag or this and that, what do we get? On average, usually you get fails. But in order to look for things that are consolidating, we can use dashboards. And if we're using dashboards, we don't have to look at charts all day. So then you can click on some of these red tabs here, and that'll bring up your chart to see whether or not it's consolidating. But the consolidation isn't everything, as you know. And what happens is with these consolidation and price price patterns, they can fail. They can fail very easily. It happens to everybody. They're trying to trade some, double bottom or bear or bull flag, and it just doesn't work. So here's some examples, right? You've got your double bottom, your cup and handle. We got some bull flags here. They're just failing, and the reason why it's failing is because you don't know what's going on under the hood. I mean, you can do the price pattern all you want, but institutions aren't saying, hey, let's draw a cup and handle here, and then we'll go. That's not how it works. So that's going to lead me to the next item, which is you got to know where a demand zone is with these, right? You've got to know where a likely bounce is, where institutions looking to buy, and how are they going to hold it up? And this leads us into advanced volume. So we're going to go over volume profile. We're going to go over anchored VWAP and multi-time frame volume profile. So before this, we know what events are coming. We can see consolidation. Now we're trying to understand, do we have support there, or where would the support be? And if there was support, where would we enter an order? Right. So this is what really helps you look what's under the hood and can really help you understand where you place your trades. So why does volume matter so much? Institutions are looking to make trades in areas where there's enough liquidity that they can get a price with the block orders, the size that they have. And they're not looking to bottom tick or top tick anything. They're just trying to figure out where these institutional traders can make a trade and get that price that they're looking for. And on the other side, market makers are looking to make a ton of money in volume zones, right? They don't make money either way on any kind of move. They just want to find where the price is going to generate a ton of volume, and that's where they're going to make their money, right, on the spreads. So What happens is then price tends to revert to these zones. And you can see not only where it's reverting to, but then if they move out of them, you can start seeing where large volumes might be trapped or offside. So if you see a lot of short sellers, a lot of short volume in a big volume node, then you know they're trapped, especially if the next day it's going to be gapping up above the previous day's high. We call those kicker candles where we know these guys are trapped. And that's when a lot of times, markets just take off to the races because these guys are trapped and they know it and they need to buy back, which just further exacerbates what's going on. So let's kind of take a look at the different types of volume here. So this is kind of a normal green hammer setup, just on a intraday view, on a 10-minute view. And I'm just going to go over some of the basic concepts here. I'm sure a lot of you might be familiar with it, but let's go ahead and walk through that real quick. And if we start off, we can see that the volume area high is denoted by this yellow line here. And we have a volume area low right here. And then we have the point of control. And these areas are calculated by the 70% of where 70% of volume happens on any given day, right? So on this day, this is where 75 or 70% of volume happens. And the point of control is where the most volume happened at that price in that 70% zone. So if that makes sense, this is just where everything is happening. And if we look at the prior day, we can see the same thing. We can see the value area high, point of control, and the value area low. So a lot of the trading happens within these zones. This blue line is the anchored VWAP. I like to use this as a continuous volume weighted average price. It's kind of like a trend indicator for me. You can filter it and see if it gets above, then we know that they're trying to bid it up a little bit. And then on the right side, we have kind of the raw volume at price bars over the last 2 days. So here you can see where all this volume happened here. And then on the current day, you can see where the volume is happening as well. So this is the view that I want to see things, or I want to see price, whether it's got support, whether it's got resistance. That's how I'm going to look at it. So let's go ahead and talk about what's happening on prior periods. So if I'm on this current period, the way green hammer trading looks at it is how is the prior period being tested? All right, so let's go to the next one. So what we do is we extend the volume area highs and the volume area lows to the next day. So if I'm on the current day and we're looking at these white lines here, this is an extension of the prior period. And we want to see if price is going to test these levels. And on this day, it certainly did. It hit the very top, and without much, not even a close under it, it bounced. And that's when we're looking for trades, when all other factors are looking in our direction, these are the points where we're looking to make trades. All right. All right, so let's talk about multi-time frame volume profile. So previously we saw, the current day and the previous day on an intraday view. Now we also want to take in what's happening on the monthly and weekly. Right, so right now we have a daily chart, but we have monthly. We're on the top left here. We're on the monthly volume profile, and what we've done here is we've actually replace the current volume profile with the previous period's volume profile. Got it? So the current volume would be here on the right, the volume profile would be here, and the previous period we've overlaid on the current time period. So with this in monthly segments, we've put in the monthly volume profile, and this is denoted by the volume area high, point of control, volume area low. Right? So we've also done this on the weekly. So we've used the weekly, but in order to put the weekly on, we use an hourly chart. Again, we're taking the previous week and we're overlaying the overlaying that on the current week, and then putting the current week just in front. So it's almost like a projection of where price might bounce. Right? So that way we can figure out where orders are being put, or where we can put orders. So, and then at the bottom here, we can see, again, the previous slide kind of cleaned up a bit. And we can see the current, well, the previous volume profile here. And then we see the current volume profile here, and we see what the previous volume profiles and how they react to price. So if they're highlighted on the intraday, it really just means that's the cash session. Okay. So in this case, you see how it bounced right off of this and back into here. You might be wondering what some of these purple lines are. These are previously untested points of control, high concentration of historical volume, where price is generally kind of has a magnet to it. It likes to touch these and test them. So good point of interest on any time you're trading. So this is just kind of an example of what FOMC day looked like, right? Actually, let me just go back one. So when we're looking at this in a holistic way, what we're trying to see is if price can stay above these levels. So on a daily or intraday chart, we are looking to see if price can stay above the previous. Can price stay above the previous week? And then can it stay above the previous month? And the most sensitive areas of support are going to be the monthlies, right? This is where all this volume is accumulated. So if they touch, it's like a live wire. It just gets hit and it's off to the races. You see that constantly. You can see it in the arrays here. So you see the previous month just consolidated between the point of control and the top of value. So we've got a little bit of consolidation and then a break. We've got some consolidation and a break. But the support levels are coming from these humongous volume areas. And what we like to see is how sensitive these points of control are. And that's the basis for a lot of our trades. And as a filter, what we're looking for is it bullish, right? Is this bidding process going up? And in this case, it is. And in this case, it is. It's above the point of control. And we want to see if that's going to hold. And what that does, it gives us an asymmetric risk to reward. And before we go through some of the targets and how that works, we want to see, okay, where should we start placing our trades? And these areas are it for us. Give me one second, get some water here. What volume time frame? I'll take a look at that in a second. So the volume overlay that we're using here is just the entire day previously overlaid on a 10-minute chart here. Okay. So going back to the FOMC. So you can see what happened. The previous chart was, I think, into the 18th or 19th. And you see how it tested, we're on the upper left here. You can see how it tested the point of control and then it broke out of the volume area zone and actually ran almost 2 standard deviations above the weekly, which is a very big move. And into FOMC, we can see, at least how I filter things out, is price never even opened above the previous volume area, the volume profile area, right? It gapped down, didn't even flirt with it. We have some trend filters that are telling you, well, this is not a ripper face rally at this point right now. It's got to get over this at the very least. And on the weekly, even before the announcement, price was dipping back into the previous week's volume area zone and the volume profile zone. And when that happens, it's commonly known as like the 80% rule. So if you've already broken out and it starts coming back in, it's gonna 80% chance it's going to retrace back through. And that's exactly what happened. Did I trade it? No, it's not something I'm looking to do, but it certainly wasn't a long for me at any point in time. I was just kind of watching. And at this point, it was, could it have been a short? Sure. But, for me, I'd rather wait for the smoke to clear and see what happens on the next day. And in this case, you can see that we've got our next month volume profile setting up. So the win really, really matters, right? And as of today, as February 1st, you can see that this is starting to form, and let's see how price starts to react to the volume area high on the month. And what did it do? It is testing. This is as of earlier this morning. It is testing the top of that value zone. And the points of interest for us would be, all right, the point of control, obviously, the bottom of value for the weekly, and we still would love to see price get above the point of control here. All right, it's a new month. It's a little, mixed. It's a mixed bag. If we got above this, we stayed above the point of control on the week, yeah, we'd probably look for a trade in an area like that for the day. But we wouldn't press it as hard as we usually do. All right, so that really takes us into when we would press, right? When we would start pressing our trades a bit, and we're going to use a tool called gamma exposure that's usually used by market makers. And let's go ahead and walk through this. So prior, we know that events are taking place. Price has some consolidation. We see some very bullish volume profile, and the price is reacting to levels. And maybe we have some trades in, but are we still convinced this is where it happens? So if you guys are familiar with the option Greeks, these are the kind of the two big ones, at least for market makers, the gamma and the delta. And I'm not going to read all the gamma exposure definition, but for delta, they're trying to always manage delta. And that is a numerical value ranging from 0 to 1 for call options and -1 to 0 for put option. It indicates the change in the options price for a $1 change in the price of the underlying asset. So if a market maker is selling options, then these two definitions are going to be very important. Gamma is just a way of, well, to put it simply, gamma is going to be a very easy way for market makers to manage the risk because they're trying to be delta neutral. They need to know how much they need to get to and hedge by in order to be delta neutral. So they don't want to lose billions of dollars. They need to start moving things around in order to be delta neutral. So with the influx of SPX 0 DTEs or 0 days to expiration, this really gives a big, look into how market makers are dealing with gamma. I mean, generally we used to have weeks on end. You have to do it every month or just every week, but now you get it on a daily basis. You understand what institutions are looking for and how they're positioning themselves. And with 0 DTEs, what's happening is, they're putting out, at least the Fed is putting out a parade of Fed speakers every day, which introduces a lot of risk, a lot of new announcements. They've got all kinds of things happening on a daily basis that people are interested in, and institutions are really kind of like, hey, I need insurance for this. You can't just put people out there every day and move markets the way you are. So what happens is a lot of times, especially with this product, this is a way for them to get insurance and hedge and maybe even do some betting. So with the massive volume that's happening with these institutions and degenerates alike, you're getting a lot of action. And by a lot of action, I mean like we're talking 30 to 50% of the entire volume of options that is trading on any given day of all options, through the market. It is an incredible notional amount of money. So, but this also introduces a lot of potential for high gamma exposure for market makers. And what they need to do is be able to hedge and stay delta neutral, and they're using futures contracts for that, so that there's no time decay, and they can peel them off whenever and be neutral fairly easily. And we'll see some visuals on how this works. But let's kind of walk like simply how a gamma exposure is used, especially by green hammer trading. So if net gamma exposure is zero, then the market is relatively balanced. Okay, it's equal on both sides. If it's not getting pushed one way or another, it's going sideways. If we have positive gamma exposure, then positive net gamma exposure, and the high total amount of gamma at a particular strike is nearby, then that's where price is going to go. Conversely, if there's negative net gamma exposure to the downside, and the downside strike has a ton of gamma, then it's probably going to go. All right, so it's the total net GEX is the momentum, and the gamma at the strike is basically the target. So you start seeing the total net GEX go to one side or another, and it starts moving from 0 to 10 to 20 to 50. That means there's a lot of bullish volume coming into the strikes that are above the 0 gamma line. So let's take a look at what that looks like. All right, so what we do is we watch the flows. All right, and what we're looking at here is the volume-based gamma exposure. Okay, not so much the open interest, that's kind of in the past. We're also looking at the max change in gamma exposure. And we're also looking at the major positive gamma exposure strikes and the major negative gamma exposure strikes. And what we're doing is we're watching the flows, and we're watching how the volume is running here. And what we're paying really close attention to is this net GEX number. It starts really moving past 0 and 10. It's starting to move towards that target. So let's take a look at what that looks like. So just take a look at the line. So as volume grows, it meets that strike. And then they ladder up to the next. And we don't have all of it, right? Yep. One more time. It goes kind of fast, so we'll do a slower one in a second. All right, so yeah, here we go. So we see the net gamma exposure is positive. We're seeing major positive at 48.10 right here, major negative here, and we're watching the flows. And this white line is the spot price of SPX. So just take a look at not only the form of the ladder here on the call side, but also what's happening on the put side and how it gets overwhelmed. And then it ultimately hits these price targets. And this is why, like, sometimes the market seems like it's levitating. See how it's just getting absolutely, it's just crushing put volume. Net gamma exposure is over 160 billion. And it just keeps going. And that's basically what laddering looks like. So now that you've seen how net GEX and the events, price action, volume, and gamma exposure kind of work, let's put it all together. It may seem a little disjointed, but when we put it all together, it's sense. All right, so this is so this is the January 8th kind of breakout monster rally. These white lines were the gamma exposure targets at the very beginning, so let's go back. Yeah, so these were already put there, right? We already knew where, from the downside to the upside, where the market might go. But once we kind of broke consolidation, and we'll show in the next slide where the support was, but we also kind of knew where the targets were. And that was initially at 720. But we could have pressed. Why? Because NetJets never went past zero. Nothing, nothing in this price action is breaking to the downside, and it's getting massive support. And that's 40 points within just a few hours. We get another 50, almost 60 some odd points right there, right? So now let's look at what the gamma exposure was doing at that time. See how 4720 is already there? It was already there. They're already looking at that, and let's look at NetJets. It just keeps going, right? Never goes below zero. Never goes below zero. The flows keep coming in higher. And they keep pushing this up, right? They hit 1 o'clock Eastern, and then we really start seeing a ramp. And you also start seeing that the put volume goes to next to nothing with almost an hour. And it just keeps going. So this is how you can take the magnitude and your price targets. So let's see what that looked like on CPI. It's a big green bar here. This is the volume profile that we have. And you see right at the bottom, maybe you can tell, but that's the point of control. And right as the market opened, about 10 minutes in, it tested it, and then it broke through the top of value here. Okay. And it was testing the point of control here. It was breaking out the top of value on the weekly. And then on extreme low time frames, like a 2 minute, it never even broke through a trend filter. I mean, these things, when they start lining up like this, when you see these opportunities, you've got to really, in your mind, think, well, everything's lining up. This is kind of when it should happen. And what you do is you can use that gamma exposure tool to confirm it. So you can put in your trade, and then you can either let some runners go, or you can start adding to it on a low risk basis, right? You start putting money in, you're gonna have a hard time losing it, unless you're obviously buying at the very end. Okay? So that was CPI. Now we're looking at the January 19th OPEX squeeze. And it's kind of the same thing. You had a consolidation, you had a break coming into the OPEX with also, there was a parade of Fed speakers that day. And this almost had this exact same type of action. And we had another 50 some odd points that we go for. So let's look at what the gamma exposure tool is doing. Again, we've got gamma exposure never goes below zero. It would be red, and you would see it really start testing like 10 billion down to the downside, 20 billion, and really try to hit this first. But when they're bullish, they start hitting it very early. So in this case, I mean, let's move it. Yeah, so in this case, they were near 100 billion by lunchtime, and the put side was completely demolished. There was literally zero reason to think that you should go short in any given scenario. You really should start looking for tiny pullbacks on small time frames to hit that next laddered up level. And as you can see, 240 billion, 300 billion positive net gex just kept going. So this is what it looked like on this day here. You can see at the bottom, you see if we're looking at it filtered wise, price was above the volume profile on the intraday level. It was above the point of control on the weekly, and it was testing these levels, even pre-market. Right before the market opens, it's testing it one more time, and then bam, and bam. right? You can see it push through the top of value on the monthly, which is an even bigger, more bullish indication. And again, what we're seeing is a bullish array of monthly volume profile. They are quite literally pushing this up with volume. So let's take a look at what FOMC did yesterday and see how much of a difference it is, especially on big at the big news time, right? It just completely reconfigures what it looks like. And you can tell on normal days, especially leading into it, and it's when it's fairly balanced, like there's just not much going on. It's chopped, right? And that's what it looks like, and it's going to look like that. So then you start watching the flows. You see it get pushed up just a little bit at the announcement. And then once JPAL starts talking and then stops talking, they just pile in and push it all the way down to the 4850 level, which at the beginning was the initial level that was kind of presented, right? The major gamma level, even before they announced. So, you know, if you're trying to do coin flips, at least you know at least one of these two they're trying to hit. And if you're going to the downside, that's not a bad area to shoot for. And, you know, let's see what happens. Now, 4850, this is the SPX cash. It hits it right at the end of the day. So the white lines are the major levels. And yeah, that's how we filter through, how we gauge momentum and the magnitude of certain moves and try to pick our price targets. So if we're going to recap here, we really got to understand market context and when high impact events will happen. It's crucial. You can't not know what's going on, otherwise you will get crushed. And kind of showed that. Price action that shows consolidation into the event can show that there's going to be a very big move that's coming. And then the multi time frame volume profile arrays, they should be in line with a bullish structure. So there should be bidding up at the key levels and the demand zones where they live. So this is where, in reality, institutions are active. And then just for extra confirmation in Confluence, we want to use intraday volume-based SPX 0 DTEs. I mean, it's a mouthful, but you see how simple the tool is. You can see where these things are going, and it will help you not only stay in a trade, but actually have some targets. So is it enough to build strategies around? It is. So if you have other things you look at, great. You can use these as kind of a starting point. But other elements that I include are like time, the trend filters, which you saw a little bit of, short interest, what the big structure is, convexity, and then I have my own trade execution parameters for these type of deals. But you can literally have these 4 components, and literally you can create a trading system out of it.